All right, well, it's been about a minute, so we'll go ahead and get started. My name is Neil Kapelka, and I'm the Advantage Markets Coach for IIAT. And I have the privilege today of introducing our speakers for today's presentation. Gail Yantis is the Vice President of EMG Insurance Brokerage, a life specialist, and has been in the insurance industry for over 25 years. She has completed the Certified Long-Term Care Consultant CLTC training program and has earned her FLMI designation. She is a certified CE instructor and teaches long-term care, life insurance, and ethics. She's heavily involved in IIAT and further serves on the board of directors as treasurer for the Austin Association of Health Underwriters. Gail enjoys working with clients to help them obtain the most suitable products and to understand the process. She's a firm believer in relationships and works hard to develop and maintain them. Tom Archer is the Chief Executive Officer of EMG Insurance Brokerage. Tom entered the insurance business in 1967 and continues working in the insurance industry with the same passion he began with. Tom has served as chairman of the board for Insurance Designers of America and as a board member and is past president of the Society of Financial Service Professionals. He has both the Chartered Life Underwriter, CLU, and Chartered Financial Consultant, CHFC designations from the American College of Financial Services and holds the FINRA Series 7, Series 66, and Series 24 licenses. He is an investment advisor offering financial planning services. Tom, Gail, it's wonderful to have you both presenting on the call this morning, speaking about estate and tax planning, and please take it away.
Thank you, Neil, very much for the introduction. And to all of you on the phone, thank you for taking time from your day to spend an hour. I think you, at the end, I hope you will find it very useful, everyday information. And so with that, I'm just going to turn it over to Tom so we can get the best use of our hour. So take it away, Tom.
Morning, everyone. Starting off next, Charlie. We'll go to a slide here. The Treasury Department publishes data about federal estate taxes. So for 2020, there were 1,275 tax returns, gift tax or estate gift filed. And from that, the Treasury Department put $9.3 billion in the bank. They have technically right now 3,441 with gross estates that are worth $122 billion. So we'll hit the next slide, please.
Tom, since we titled this Estate and Tax Planning, will you cover some of the details on the current estate taxation and how it might affect each and every one of us at our level and not maybe that higher level all the time?
Exactly. So the next slide shows that 2020, we had an $11.58 million exemption per individual. So that means that if you are a married couple, you would have double. The husband and the wife would both have 11.5 million per individual. 2020 it jumped to 11.7, and now at 2022, each individual can pass up to 12.06 million. For a couple, it would be $24.12 million. So these are super high. Basically, when this gift and estate tax were passed, the Republicans were in office, and the Democrats approved this only with the idea that the estate tax and gift tax would fall back in 2025. So next slide.
Excuse me, what does fall back mean?
Fall back means that if Congress does not change that, fall to the $6 million, in 2025, it will fall back to a $6 million exemption, which would mean $12 million per family. So it's a big drop in the estate taxes. So it's right now, Biden was trying to put across a $3.5 million per person, and it was rejected by his committee, Democratic committee, actually. So now it looks like it's going to happen only in 2025. So, and when we have a family member that passes away, many decisions have to be made, many emotions to handle. The last thing anyone wants to think about is taxes. But when a death occurs, the IRS gives you to following year, taxpayers does not have to file his final income tax filing. Happens a year later by April 15th. So next slide.
So the most important fact to take away here, Tom, is that unless Congress does something and changes this exemption, in 40 years it's going to drop to $6 million per individual. So we probably, as at our property and casualty company, as P&C commercial lines or personal lines agents, we probably have many small business owners that potentially could be in that category of $6 million. Isn't that what I heard you say, Tom?
Exactly. So the main figure here at 6 million, people right now have the ability to gift or pass on up to 12 million at death without any kind of a estate tax. So now's the time to basically do your planning. This is also, if you do have over $12 million estate, there is an estate tax return form 706 that's due within 9 months of the date of death. They will allow a 6-month extension if needed. But 9 months is not a lot of time, especially if you're super wealthy.
Tom, can I tell you a little personal story here? Everybody on the phone, some of you know me, some of you know my story, but at 28, my 32-year-old husband didn't wake up one morning. We had a 7-year-old child, and he was a small business owner. He owned the business, but he was the business. So if he wasn't there, the business didn't continue. I was a stay-at-home mom, and all of a sudden, I had to deal with this. And when you talk about the stress of dealing with it, first I had to deal with my 7-year-old losing her father. Then I had to deal with my husband dying and leaving me, trying to read his books and put it all together, because I'm telling you, the IRS literally was knocking at my door because I didn't file this on time. I was 28 years old. I didn't know it. And so I had to get a lawyer, and the lawyer cost almost as much as the estate was worth, because there was no will. There was no, we're going to talk about it later, but none of those documents were in place because we were 28. We were young. We didn't need this. So I can tell you from a personal perspective, not only is the stress of losing a spouse hard, but then having to deal with all of these issues makes it about 10 times harder. So.
Very good. Next, Charlie. Next slide, please. There you go. So Monday of this week, we have a lawyer that writes for the Houston Chronicle. And this was in the Chronicle on Monday. Why is it so complicated to settle an estate? And
Tom, just can you make sure that everybody understands that an estate could be as little as a couple $1,000s or maybe just a house. It's not a term only for the wealthy. It's a term that clients are, even the people that are sitting on the phone need to understand could apply to them even if they just own a car or a house or a condo, right?
Exactly. And this, Ron Littman points out a couple things. Why is it so complicated? Many people fail to plan. Okay, he points out a lot of people won't even complete and sign a beneficiary form. So there's also disputes between heirs. But to die intestate, they call it, without a will, requires that family normally to hire an attorney and to actually probate the will as to who gets what. So if you die intestate, the judge is going to inform that the rules in the state of Texas are, if you're married and have children and you don't have a will, that the wife can actually receive half of the estate, the children get the rest. So there are all kinds of complications, obviously, especially when your children are under age 18. And, you know, how do you take and put half the money toward the kids? So
Tom, the story I just told you, I'm going to add that we had to do that. We had to hire an attorney. We had to go to court. Like I said, I had a 7-year-old. We didn't have a lot, but we had a house, and we had a truck, and we had a car. And I went to court, and the judge took half of everything I owned and told me I had to put that much cash in a CD that would be governed by the judge until my daughter was 18. And I asked him, I said, Your Honor, can I take money out of it to feed, clothe, take care of her? He said, no, ma'am, that's your problem. My problem is to protect this child's estate. And that is exactly what he said to me. So that money, which would have been really nice to this widow here, was put in a CD. She got it when she was 18. Again, it wasn't a lot of money, but it would have been really nice for me. So I have lived that event.
So the basic planning involves creating a will as named here. So, and obviously when you create a will, you have to keep in mind who fits best to be your executor to carry out your wishes in the will. Obviously, you name the beneficiaries and you identify each one of those. And if your kids are underage, you want to name a guardian. Again, if you do set up the will and you do some planning, then the complications to settle an estate are not that bad. So you don't want to leave those decisions to a judge. Okay, next, Charlie. So when we're creating a will nowadays, it's not just a will that you need to create. Okay, so we've listed here some of the things, healthcare directives. Okay, you name a HIPAA form, you name people that you would like to have any information medically on a HIPAA form. Okay, and a HIPAA form directs hospitals, doctors, and all to give information on health to your spouse, number one, maybe to your kids also, but you name on that HIPAA form who they can release information to. And you want to do, you know, the husband and the wife both want to have, you know, each other, but also probably kids. We also know that should you, you know, you're the grandparent and you take the kids for a weekend, you want to have a medical power of attorney with the kids just in case something were to happen. As you know, our kids are subject to emergency room action occasionally. So then secondly, the directive that you have, do you want to be kept alive with the machines that are available today? You know, we have obviously times when you're not conscious and decisions on your medical care have to be taken. So you have a medical power of attorney. You name someone besides yourself that can basically give the doctors a health directive to take certain action. You also have medical powers or powers of attorney for financials, digital. Digital is the fairly new power of attorney, but it allows someone to take over basically the words and sign-ons for the computer, you know. And we have, you know, nowadays we have so many things that involve computer passwords. So this allows a person to you want to leave your wife the passwords to all your accounts. So digital. We also have in the state of Texas, we now have the right to leave real estate. Charlie, switch the next slide, please. And
So, Tom,
we have the right Go ahead.
Tom, since we're in the business as P&C agents, we're in the business to help people plan and insure the risk. So what should we all be looking for?
Well, again, with planning, an overall view of wills include trust, include any way to name a beneficiary. Right now, if you name a beneficiary on contracts, that's life insurance, annuities, your pension plan, your stock accounts. You can name beneficiaries in all these places, but you must do so. If you put down a estate, that was going to take it into the estate where maybe the judge may have to decide who gets this property. So the named beneficiary on a person, excuse me, is the best way to go. So, and again, if we create a will, if you have small children under the age of 18, a lot of times you want to include a trust. And the trust basically would take care of the children should something happen to you. So you have a living trust, which also avoids probate. But once an asset is put in a living trust, you have the problem of, do you want to move it out of that living trust? And if you do, you have to contact an attorney to get it done. So in a lot of states, living trusts are used all the time. The state of Texas, our system doesn't really require it because you can hire an attorney and the probate fees are not fixed. Some of the probate fees in certain states are fixed and they receive basically could be a 5% of the estate going through probate.
So Tom, usually when we hear the word trust, we think about something for very wealthy or affluent people. Is the trust something that, everyday working people who, go to the office every morning, how would they use a trust?
Trusts are very good in certain situations. If you have special needs children, if you have special need adults, okay, a trust can basically let that person be supported from the trust and the benefits by leaving money into that trust for the kid long term. So trust can be valuable.
So as a P&C agent, as a personal lines or commercial lines agent, maybe a good question asking the clients is, do you have a will?
Right. And so, we're used to asking customers, they have a business and a partner in the business. Do you have a buy-sell agreement? Okay. Part of planning is, looking at an overall picture. So that's why we bring in, number one would be a will. Number two would be the things we've talked about setting up. And then trust, but also business insurance. We have different insurance needs go along with the planning that we would do for death. So next slide, please. Okay, so beneficiary designations are very important. I have an older brother who was divorced like 10 years ago. Last year, we went through his portfolio of investments. He had an annuity with his first wife named as the beneficiary on that. One of the problems is when you name the beneficiary, it's not easy after a death to change that from the beneficiary you named. So you want to always update, especially if you're going through a divorce or you're going through other things. Don't forget, beneficiaries are crucial in all the things that you name. And you'll notice on the bottom of this, we see real estate. Okay. 2 years ago in the state of Texas, the legislator allowed real estate to pass by beneficiary now. So my wife and I have a one-page form that's done by an attorney. It's got to be in writing. It's got to be at the first death, the survivor would own the real estate that we have. So, and Each one has to be separately. You have to have the technical address, and it's got to be also in the county of that real estate. It's got to be filed for with the county so that they know on death the survivor would automatically be the owner. So these are little things that can make a complicated situation relatively easy.
So Tom, instead of like in my case, when my husband was, my house had to go through probate and I had to pay an attorney and it was a long process. Instead of that, then you're saying that just this one page that probably isn't very expensive to have done by an attorney, and that would have automatically passed to me. Is that right?
Exactly. So
right, that would save me a lot of money.
So when we're out there and we're talking about risk and how we cover the car insurance, we cover the homeowners, and we cover all these different things. And so if we can put real estate on the list to make it simple, that's kind of an idea that a lot of people in Texas don't know about. So next slide, please. Okay. Talk a little bit about gifting. We have the right, everyone in the U.S. has the right to gift $15,000 annually per person. So if you wanted to make a bunch of gifts, you can spread out $15,000 a year. However, if you go over that $15,000, so you have, let's say, 4 kids, and you want to give each of them $50,000, you can do so. What you have to do, though, in order to cover the excess over 15, is file a gift tax return. So obviously we know the estate and gift tax rule we showed is 12.06 million. So you have a lot of room in there to gift money, okay? And again, you want to gift it. If you're going to gift some money, it's now, between now and 2025 is the time to do it. And then file the gift tax return and show the excess over the $15,000 per person as the use of your lifetime exemption, so that when you die, they would take that amount off of the 12.06 million. Next slide, please.
Tom, can I create like an immediate estate as again, just working people? Can I create an immediate estate using some type of life insurance policy and take care of some of those tax-free benefits?
Absolutely. And people don't realize, but when you buy a life insurance policy, you are actually creating an estate. And so, we sell people that already have a lot of money. We sell people, if they have a lot of money, sometimes we sell them insurance for the estate taxes that may come due. But even if you buy $1 million policy, you have basically created $1 million estate, okay? And the benefit, life insurance is preferred property because state and federal governments recognize tax on those policies that no other asset has. The advantage of life insurance is it grows tax-free, death benefits tax-free, and people don't realize too, when you fill out a form to borrow money, okay, one of the things that bankers really look at is, do you have life insurance, okay? And basically it tells you are concerned about your family. It's basically the thing to do. It shows that you are a planner, okay? And banks like to loan money to people that plan. So other actions. Let's talk about retirement. I have assets that are spread out. I have different companies that have life insurance policies. I have annuities with several companies. And I have all these things are spread out, and I get reports all over the place. So, I'm looking forward to consolidating some of those assets in safer, basically a lot of it's in mutual funds. So as you get into retirement, you want to invest in assets that are not really subject to up and down in our markets. Okay, we've had a great run with the market for the last almost 10 years. And now we have inflation, raising interest rates, other things that affect investments. So I'm looking to consolidate some of my retirement assets to make it a little easier to get an overview.
Tom, isn't the statistic the average person has 7 employers during a lifetime? So many of those times they've got 6 other maybe 401k or 403b accounts that they've totally forgotten about because they're with an ex-employer. And they're just sitting over there and nobody's looked at the beneficiary or how it's invested. So maybe everybody just needs to sit down and look at their own things.
Exactly. So, one of the things that we do in the life insurance business is we try to coordinate the different policies, annuities, long-term care. We look at an overview, try to get a big picture of the financial risk that they are basically have policies with. We make sure the life insurance policies are performing. Okay. One of the problems in the insurance business is that, we have companies that have moved out of the life insurance business. And these people have been paying a premium on these for years, but do they know the projection of what's going to happen from now for the next 10 years, 20 years? So what we try to do is make sure the policies that they're paying on are projected to continue in force. So we also look at, the plan for the assets in retirement. We have a portfolio of different investment. Which investment is the best one to spend down? Okay. Now we know the government requires a minimum distribution at age 72 on any qualified plan money. So in effect, you withdraw and you pay tax on that money. And the key on this is those are good assets to draw down on because your kids would inherit those with the same tax that you have. In other words, those have never been taxed. When the kids receive them, from death, they basically have 10 years to spend all the money and pay the tax on it. So it's not bad to go ahead while you're alive, spend those assets rather than other assets that are going to have what we call a stepped up basis. Okay.
So Tom, you're saying that if I have an IRA with my employer, or I have 2 or 3 IRAs and I pass away and my children are the beneficiaries, they can't spend them the way they want. They can't save them. They have to do something in 10 years with my money.
Correct. There's a recent law passed 2 years ago, actually, but it says that inherited IRA monies, you cannot transfer those to a Roth IRA, and you can take them either lump sum and pay the full tax or over a 10-year period and pay the tax year by year on each withdrawal. So, but they have to be totally taxed within a 10-year period of time. So it might as well, in my book, you go ahead and draw down. When you turn 60, it wouldn't hurt. You got to remember now, since 2012 to 2020, if you had $500,000 invested, okay, that's going to be worth somewhere in the neighborhood between $1 million and $1,250,000. So there are tons of people out there with money in these IRAs, and it's not a bad idea to show people, hey, you have to take a withdrawal, minimum withdrawal, and that withdrawal may be $40,000 or $50,000. Why not consider a life insurance contract, which will take that from taxable to a non-taxed product. So we have a lot of people right now are looking at minimum distributions, and they pass on not only their 401k, IRA money, but then they pass on a tax-free amount in the life insurance policy. So, and the other thing in retirement is you want to consider, if you don't already have it, the long-term care insurance and the new indexed annuities. I was reading an article in one of our trade magazines that we had $97 billion worth of annuities sold in 2021. So it's a real hot item. And the key on the indexed annuity is you can't lose money. So you have basically, you're going to have a rate of return that's higher than a bank account or a CD account, but also you can't lose money. Now they tie it to an index, which is normally the S&P 500. The S&P 500 for the last 10 years has averaged over 8%. So it's not a bad place to consider having some of your clients invest. Next slide. So, one question for property casualty agents and advisors to ask, do you have life insurance? Have you checked your beneficiaries? Some of the stuff that we've gone over today is very important in the life insurance area. And then if they say, yes, I have life insurance, when was the last time you looked at your policy? Have you had an in-force ledger run? Have you done anything to check on it to make sure? Or a lot of people have term insurance. When does that term insurance run out? Well, if it's only got 3 more years, why don't we replace, by now rather than wait the 3 years, when your health could change. So be active in asking about life insurance, annuities, long-term care, and it can be another revenue stream for you with just the question. So
Tom, I'm a PNC agent. I'm a commercial lines or a personal lines CSR. If I ask these questions, I don't know how to help them. So what do I do if I ask my client these questions? They say yes, heaven forbid.
That brings us to EMG Brokerage, Insurance Brokerage, which is our agency. We have one of the finest reps in Gail Yantis to help with these questions. So keep Gail in mind. She has the answers for you. Once your client says yes, get her involved or get our agency involved. One thing I might mention is we had a group insurance producer, and he had sold a medical insurance plan to a group, and there were 50 employees, and he worked with the human resource person at the business, and by chance he said, is the owner in? And he went over to Mr. Smith and shook Mr. Smith's hand, thanked him for the business, and as he was leaving, Mr. Smith asked him, do you sell annuities? And the largest sale for this agent's career was 3 annuities on employees that this employer wanted to take care of. And so, asking the question can mean a lot of money, long term. So, ask the question, see what happens. Okay, next slide. Or is that it?
That's it. So
Okay,
Tom, thank you. Hopefully some of us will sit down and look at our own personal situations, and hopefully it motivates us just to ask our client the question. As Tom said, here at EMG Insurance Brokerage, we will literally do the policy reviews for your clients. We will look at their needs. We can do needs analysis. We can do everything from a simple term policy to hundreds of millions for a wealthy client. but it doesn't matter, whether your client needs $250,000 worth of term coverage or $10 million worth of something else. It's your client, and we want to make sure they're taken care of. I personally don't want anyone to have to live through what myself and especially my 7-year-old daughter lived through. It was a difficult time. So we thank you, Tom. Does anybody have any questions?
If anyone has any questions, please use the question box on the control panel to your right.
So while I wait and see if there's any questions, let me remind you that for every session you attend in our series of 6 that we're using, you get a chance to win a $500 Hyatt gift card. So somebody will be able to spend a nice weekend at the Hyatt. So each one of you, and I have your names, will get that from this session. Our next session is March 17th. So it's always the 3rd Thursday at 11 o'clock. And our next session is on buy-sell coverage. So you as a commercial lines agent or commercial lines CSR can understand the concepts, the principles behind buy-sell insurance for your small business, large business clients.
One thing we might mention is that during this pandemic, insurance companies have decided that they could issue insurance without full medical exams, without getting people blood and urine. And so we have non-medical limits up to $1 million now, where you can get a policy or get an insured covered for up to $1 million through age 60 and not have to do doctors, not have to send them to a doctor.
Thanks for reminding me of that, Tom. So I don't see any questions. We appreciate your time. We're going to give you back some of it. Tune in the 3rd Thursday of next month, and you'll hear about buy-sell from one of our partners or one of our larger carriers. So have a great weekend, and thank you for attending.